Welcome back to the deep dive. You know, if you've been following any financial news lately, it's impossible to miss crypto. It's not just some niche thing anymore, is it? It's huge.
Oh, absolutely. Dominant force is the right word. The numbers,
Yeah.
they're just, well, staggering. Think about it. April 2025, the total market cap blew past $2.6 trillion.
Trillion. Wow.
Yeah, and just look at last year, 2024. Bitcoin actually outperformed a lot of the traditional players, NASDAQ, gold, even the S&P 500.
And that lure, that potential for massive gains, it's pulling everyone in, right? From like regular folks curious online to the big institutional funds.
Exactly, and that's kind of our focus today, isn't it?
Yeah.
That high reward potential comes packaged with some really, really high risks.
Right. We're talking volatility that's just wild, makes your head spin, and an environment that's, let's be honest, absolutely teeming with scams.
So our mission for this deep dive is pretty straightforward. We want to give you, the listener, a kind of essential roadmap. How do you navigate this? We're going to unpack, say, the 5 most common and, frankly, costly investment mistakes people make. And crucially, give you the practical know-how to spot and guard against the specific scams out there.
Because they target everyone, newcomers and even seasoned investors sometimes.
They really do. No one's immune if they're not careful.
Okay, let's get into it then. One thing our sources really hammer home is they hear these stories, right? Instant millionaires.
The lottery ticket winners?
Exactly. But those are the exceptions, massively so. This isn't some magic money machine. It's investing. And it needs the same solid principles as, any good personal finance strategy.
That's the core point. Let's start with the first big mistake, the first trap. Lack of research. Just jumping in without understanding.
Assuming it's easy, maybe.
Yeah, or treating it like buying a lottery ticket instead of an investment. You really have to approach this almost like a venture capitalist looking at a startup.
Okay, like a VC. What does that mean practically?
It means understanding 2 key things. First, the asset itself. What is it? What does it do? And second, how are you planning to hold it, to custody it?
Right, because that's not trivial either. It's way more complex than just clicking buy on some app.
Oh, far more. You've got choices.
Yeah.
Are you going through, say, an ETF with a regulated broker like Fidelity? That's one way.
Okay.
Or are you using a centralized exchange like Coinbase or Binance and trusting them as your custody partner?
Which has its own risks, as we know.
Indeed. Or are you going full decentralization, becoming an active blockchain user, managing your own keys? That's a whole different level of involvement.
And then there's the project itself. You said dive in. What are the sort of practical checkpoints for someone who isn't, a coder?
Great question. You don't need to read the code usually, but you must read the white paper. That's non-negotiable.
What are you looking for in the white paper?
Is the team credible? Do they have experience? Are they public? And fundamentally, what actual problem is this project trying to solve? Is it a real problem?
And does the solution actually make sense?
Exactly. If the white paper is super vague, full of jargon, but light on specifics, or if the problem it solves doesn't really exist or already has tons of better solutions, huge red flag.
Okay.
You also need to differentiate. Are you looking at what we might call blue chip, crypto, think Bitcoin, Ether things with massive networks, established use cases, years of history,
Versus.
versus something like a meme coin, Dogecoin, Shiba Inu, things like that?
Yeah.
Their value is driven almost entirely by community hype, social media sentiment, very, very different risk profile.
Got it. So know what you own. That's step 1. But once you own it, you immediately face mistake number 2. Ignoring market volatility.
Mhm.
I think people hear volatile, but maybe don't grasp the sheer scale compared to, say, the stock market.
They absolutely underestimate it. In traditional markets, we start getting concerned if there are daily swings over, say, 1%. You have about beta values
That's okay.
in crypto. Swings of 10%, 20%, I mean, even 30% or more. That can happen in hours or days. It's just a different beast entirely.
And that kind of movement, it messes with your head, doesn't it? It plays right into fear and greed.
Perfectly put. It's psychologically brutal. It pushes less experienced people, or those who haven't prepared, to sell at the worst possible time, usually near the bottom, locking in huge losses.
Which leads to that famous crypto term, HODL.
Yeah, HODL. Started as a typo on a forum, apparently, for hold. Now it means hold on for dear life.
So it's really an endurance philosophy.
It is. You have to have the conviction, based on your research, hopefully,
Right.
and the mental fortitude to ride out those insane dips. It's similar, in a way, to how a traditional investor nearing retirement might shift to bonds, less volatile assets, because they can't afford a sudden shock to their portfolio.
Okay, so we've got Lack of research, underestimating volatility. Now let's connect that volatility, that psychological risk, to the very real financial risk from bad actors. Mistake number 3, falling for scams.
And this is where the numbers get genuinely scary.
I saw the FBI figure you mentioned in the sources.
It's shocking. Over $5.6 billion lost to crypto-related fraud recorded in 2023 alone.
5.6 billion.
Billion. And that was a 45% increase from 2022. So it's growing fast.
Wow. Where's that money primarily going?
Mostly investment frauds, often run by sophisticated groups, frequently based overseas, making them hard to track and prosecute. And the victims, they usually lose everything they put in.
That scale is just, it really underscores how big the target is for criminals.
It does. Which brings us logically to mistake number 4, which is all about managing your own exposure, especially given that criminal element. Overinvestment, putting too much skin in the game.
Right. So what's the sort of golden rule here? How much is too much for an asset class this risky?
The absolute first rule: never ever invest money you need. Money for rent, for bills, for food, basic necessities.
That's fundamental personal finance, really.
It is, but it bears repeating loudly in crypto. You must be mentally and financially prepared for the possibility of losing your entire crypto investment.
Okay, be prepared to lose it all. But for someone building a diversified portfolio, what's a reasonable allocation? Do the sources give a guideline?
Yeah, the general recommendation for the average person is somewhere in the range of 5% to maybe 10% of their total investment portfolio allocated to crypto.
5 to 10%. That forces diversification, doesn't it?
It absolutely does. You need diversification across your whole portfolio. You still need stocks, bonds, maybe real estate, whatever fits your plan. But also, you need diversification within that crypto slice.
Ah, okay, so not just putting all your crypto eggs in one basket.
Exactly.
Yeah.
Maybe some of the blue chips like Bitcoin or Ether.
Yeah.
Maybe a very small amount if you have high risk tolerance in more speculative altcoins or meme coins. Maybe look at projects focused on different areas like DeFi or NFTs or blockchain gaming. Spread the risk even within that 5–10%.
Okay, that makes sense. Research, manage volatility, watch for scams, don't overinvest. What's the 5th major mistake?
This one is absolutely fundamental to the whole idea of crypto, especially the decentralized part. Neglecting security measures, specifically around custody, how you hold your assets.
This is the not your keys, not your crypto idea, right?
That's the mantra. If you don't personally control the private keys associated with your crypto wallet, you don't truly fully own or control those assets. Someone else does.
But wait, most people, especially newcomers, they use big centralized exchanges, right? Like Coinbase, Kraken, Binance. They handle the custody part for you. It's easier.
It is easier, definitely. That's the trade-off. Convenience versus control and potentially risk.
And the big risk example everyone still talks about is FTX, isn't it? Even years later. Hasn't regulation sort of fixed that?
That's a really important point. Regulation is trying to catch up, but it often lags behind financial innovation, especially in a space moving this fast. FTX was a massive wake-up call.
What went wrong there, fundamentally?
They were a centralized exchange, promising to safeguard user funds. But behind the scenes, they allegedly used customer deposits for their own risky investments and executive pet projects. When the market turned, the house of cards collapsed.
And users couldn't get their money out.
Exactly. It proved, painfully, that trusting a central intermediary, even a really popular, seemingly legitimate one, carries what we call counterparty risk. The risk that the party you're dealing with fails.
So what's the alternative if you want more control and security?
The main alternative is cold storage, self-custody.
That's the hardware wallet, right? Looks kind of like a USB stick.
That's the most common form, yes. It's a physical device that stores your private keys offline. It's protected by a PIN or a passphrase, and crucially, it's not connected to the internet, making it resistant to hacking.
So if you're not using a highly regulated exchange you really trust, or if you hold significant amounts, cold storage is the way to go.
It's generally considered the gold standard for security if you're managing your own assets.
Okay, we've covered the big investment mistakes. Now, given how appealing crypto's anonymity and decentralization are to criminals, let's maybe dive a bit deeper into the specific types of scams people need to watch out for.
Sounds good. Let's start with a classic, updated for the crypto age: phishing attacks.
Like regular email phishing.
Exactly like that, but targeted at your crypto holdings. Scammers impersonate someone you trust, maybe your exchange, a wallet provider, a popular crypto project.
How do they reach you?
Usually through fake emails or direct messages on social media. They'll include a link that looks legitimate but takes you to a fake login page, or a site designed to steal your private keys or login credentials.
So the usual red flags apply. Weird URLs, spelling mistakes, urgent calls to action.
All of those. Be super skeptical of unsolicited messages asking for info or urging you to click a link. But the best defense? It's universal.
What's that?
Two-factor authentication, or 2FA. Enable it everywhere. On your exchange accounts, your email, everything.
That's where you need your password and a code from your phone, right?
Yep. Usually a time-sensitive code from an app like Google Authenticator or Authy, or sometimes an SMS code, though app-based is generally seen as more secure. It adds a crucial layer of protection, even if someone steals your password.
Okay, 2FA everywhere. What's next on the scam list?
The old Ponzi scheme, dressed up in crypto clothing, often called high-yield investment programs, or HYIPs.
High yield sounds good. Too good.
Almost always too good to be true. That's the defining characteristic. They promise massive, often passive returns like percentages per day, sometimes in a very short time frame.
How do they even pretend to do that?
The classic Ponzi mechanic. They use money coming in from new investors to pay the promised returns to earlier investors. There's no real underlying investment or profit generation.
Until the new money dries up.
Exactly. Then the whole thing collapses, the organizers disappear, and everyone except the earliest entrants and the scammers themselves loses everything. Think BitPetite or Plus Token, famous examples where developers vanished or withdrawals were suddenly blocked.
So the core warning remains. If it promises guaranteed, sky-high returns with little risk, run away.
Absolutely. That also applies to another common scam, fake ICOs, initial coin offerings.
ICOs are meant to be like fundraising for new crypto projects, right? Like an IPO for stocks.
Kind of, yeah. Legitimate ICOs raise funds to build a real project. But fake ICOs just copy the model to steal money. They create hype, maybe a slick website, maybe even a fake white paper.
But the project isn't real.
Nope. They collect investment money, often Bitcoin or Ether, promising to issue their new project tokens later. But those tokens never materialize, or they're completely worthless. The team vanishes with the funds.
How do you spot a fake ICO?
Again, research is key. Look for a rigorous, detailed white paper. Check the team's credentials. Are they real people with verifiable experience? Are they anonymous? That's a huge red flag. Also, look for reviews or vetting on trusted crypto platforms or by independent analysts. Don't just trust hype on social media.
Okay, research the team, read the white paper critically. Now, you mentioned rug pulls earlier. Can we look closer at those? They seem particularly nasty.
They are, and they're becoming very common, especially in the DeFi, decentralized finance space. It's a type of exit scam.
How does it work specifically?
Developers will launch a new token, often with a lot of hype and marketing, maybe using influencers. They encourage people to provide liquidity, basically. Deposit valuable crypto like Ether alongside the new token into a decentralized exchange pool. This allows trading.
Okay, so they build up this pool of real value.
Exactly. Then, once a significant amount of money is locked in the liquidity pool, the developers, who often control a large portion of the new token, suddenly pull all the valuable crypto, like the Ether, out of the pool.
Ooh, leaving
Investors holding bags of the now worthless new token, which they can't sell because the liquidity is gone. The floor has been pulled out from under them, thanks. Rug pull.
Brutal. How can an average person protect themselves? We can't all audit smart contracts.
True, but you can look for warning signs. Again, research the team. Are they public and doxed? Their identities known. Or anonymous. Anonymous teams are much higher risk for rug pulls.
Else.
Look for audits. Has a reputable third-party security firm audited the project's smart contracts? That doesn't guarantee safety, but it helps. Check if the liquidity is locked. Some projects use smart contracts to lock the initial liquidity pool for a certain period, preventing an immediate rug pull. Transparency Matters is the code public on GitHub.
If you can't find these things, or the team is anonymous, maybe just step away.
That would be the prudent approach, yes. The risk is significantly higher.
All right, one more major scam type. The classic pump and dump scheme.
Ah, yes, pure market manipulation fueled by psychology. Specifically, FOMO, the fear of missing out.
How does it play out in crypto?
Scammers, often working in coordinated groups, pick a low-value, thinly traded coin. They start aggressively hyping it up online, social media, Telegram groups, Discord channels. This coin is going to the moon. Get in before it explodes.
Creating a frenzy.
Yeah, exactly. They create this illusion of massive organic interest and inevitable price rise. New, unsuspecting investors see the price starting to tick up, they feel the FOMO, and they pile in, buying the coin and pushing the price up further.
And then?
Once the price reaches a target level, the original scammers, who bought in cheap, simultaneously dump all their holdings onto the market.
Crashing the price instantly.
Instantly. leaving all the FOMO buyers holding worthless bags. The defense here is clear. Make investment decisions based on solid research and fundamentals, not on hype or emotion or what some anonymous person on Telegram is screaming. Check price charts, check trading volume, check the project's actual progress.
Makes sense. Okay, we know the mistakes, we know the scams. Let's talk about actively implementing defense strategies. How do we manage that crazy volatility we talked about?
Right, active management. First, as we touched on, be really clear about your investment time frame before you buy anything. Are you trading short-term or investing for the long haul, months, years?
How does that help?
Your time frame dictates your strategy and your tolerance for dips. A long-term investor might see a dip as a buying opportunity, while a short-term trader might need to cut losses quickly. Once you know your goal, you can use tools. A key one is the stop-loss order.
We mentioned this. It's an order you place with your exchange to automatically sell your crypto if the price drops to a certain level you set.
Exactly. It's a safety net. If you buy a coin at, say, $8, you might set a stop-loss at $5. If the price crashes below $5, your exchange automatically sells your position, limiting your potential loss.
But you had a crucial tip about setting these in crypto, right? Because of the volatility.
Yes, this is really important. You have to set your stop-loss based on the specific asset's historical volatility. Crypto often has these sharp, sudden dips, followed by equally sharp rebounds.
The V-shaped recovery.
Precisely. If you set your stop-loss too tight, say, only 5% or 10% below your entry price for a really volatile coin, you risk getting stocked out unnecessarily. The price might dip briefly, trigger your sell order, and then immediately shoot back up, leaving you out of the position and missing the recovery.
So for volatile assets, you need to give them more room to move. Wind those stop losses further away.
That's the idea. You might need to accept a potentially larger loss on paper, a lower stop-loss level, maybe 20–30% down, to avoid being shaken out by normal, albeit extreme, market fluctuations. It depends on the specific asset and your risk tolerance, of course.
Okay, that's a key practical tip. Now let's swing back to security implementation. If someone decides cold storage, the hardware wallet, is right for them, what's the vital care instructions?
Number 1, use a strong PIN or passphrase to protect the device itself. Number 2, and this is critical, securely back up your recovery phrase or seed phrase.
That's the list of 12 or 24 words they give you when you set it up.
Exactly. That phrase is the master key to all your crypto addresses managed by that wallet. If your hardware wallet is lost, stolen, or damaged, that phrase is the only way to recover your funds.
So how do you store it securely? Not on your computer, presumably.
Definitely not online or on any internet-connected device. Write it down physically. Store it somewhere incredibly safe, maybe even in multiple safe locations, separate from the hardware wallet itself. Think fireproof safes, safe deposit boxes. Treat it like gold bars.
Because if you lose the device and the phrase...
your crypto is gone, forever. There's no customer support line to call. That's the responsibility that comes with self-custody. We have to remember that cautionary tale of James Howells.
Oh, the guy who threw away the hard drive.
Yeah, supposedly containing the keys to Bitcoin, now worth hundreds of millions, maybe close to $800 million. He accidentally threw out the physical drive holding the private keys. An error in custody can be unbelievably costly.
A very expensive mistake. And, okay, if you choose not to self-custody, if you stick with a centralized exchange...
then the absolute minimum is enabling that two-factor authentication, 2FA we talked about. Use a strong, unique password for the exchange and enable the strongest form of 2FA offered, preferably an authenticator app.
Got it. Finally, for ongoing learning and research, where should listeners look for reliable information in this often noisy space?
Well, the major exchanges themselves, Coinbase, Kraken, eToro, Binance, often have pretty good educational sections covering the basics. For tracking prices, market caps, trading volumes, sites like CoinMarketCap or CoinGecko are standard tools.
What about more like community insights or breaking news?
For that, X, formerly Twitter, is huge in the crypto space. Many project teams, developers, analysts are very active there. YouTube also has a ton of content creators who focus on crypto.
But massive grain of salt required.
Oh, absolutely massive,
Right.
Especially on social media and YouTube. You must maintain extreme skepticism. Always cross-reference information. Always apply that too good to be true test.
Right. Anything promising, guaranteed returns, risk-free profits, secret knowledge, just instant red flag.
Immediate spidey sense tingling, yes. If the project is legitimate, it should have substance. A clear white paper, a public team, development activity you can track, like on GitHub, maybe partnerships. Be incredibly wary of anything relying solely on hype, vague promises, or pressure tactics.
Okay. So, wrapping this all up, our deep dive suggests that crypto offers, yeah, potentially revolutionary gains, but navigating it successfully demands, well, a lot.
It really does. Extreme vigilance, first off, then painstaking research, really doing your homework, having clear financial goals and a strategy, and maybe most importantly, being mentally and financially prepared for the possibility of significant, even catastrophic loss.
And don't forget Uncle Sam, right?
Can't forget the tax implications. The IRS has been very clear. Transactions involving digital assets that include crypto, NFTs, the lot are generally reportable. And any income or gains you make from them are taxable. You need to keep good records.
Important practical point. And if, despite all precautions, someone does fall victim to a scam,
Report it immediately. In the U.S., the primary place is the FBI's Internet Crime Complaint Center, known as IC3. Reporting helps track these criminals and potentially prevent others from becoming victims.
good to know. So as we close out, you mentioned something interesting from the sources, these two kind of competing forces driving crypto.
Yeah, it's fascinating. On one hand, you have the original, almost philosophical movement.
Yeah.
The idea of using this technology to, upend traditional centralized finance, creating a decentralized, immutable, censorship-resistant financial system. That's one force.
And the other?
And then, let's be honest, you have a huge number of people involved simply because they want to make money. Often, quick money. The pursuit of profit.
So considering everything we've discussed today, the volatility, the continued reliance on centralized points like exchanges for many users, the sheer scale of the fraud, the constant FOMO and hype, it leads to a final thought, doesn't it?
It does. Which motivation ultimately holds more sway right now in governing this asset class's security, its stability, and its future value? Is the underlying belief in decentralization and the technology?
Or is it predominantly driven by the simpler, perhaps more volatile pursuit of profit? Something for you, the listener, to chew on as you continue to navigate this really dynamic and often wild frontier.